Hello everyone, welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over all different types of bonds and compare it to how it is looking compared to stocks, compared to the stock market, comparing specifically long-term treasuries to the S&P 500. The S&P 500 is at all-time highs. Long-term treasury bonds, all-time highs. How do you approach a market like this? How do you invest according to how the Fed stimulus is affecting this market on both long-term treasuries and basic ETFs like the S&P 500. So let me go over what we're going to go over in this video. We're going to be looking at long-term treasuries and how they compare to stocks. We're going to be looking at the weekly jobless claims number. We're going to be looking at GDP that came out and how it was absolutely horrible. The worst number the country has ever seen. 32.9% down. Literally a third of the country's GDP lost in a whopping 3 months. And then I'll be going over channel comments. I love some of the questions that you guys are asking me. You can just scroll through some of the ones that are right here. I get so many awesome comments, and I specifically like ones that are questions. Any questions that you guys might have for me, like for example, I'm wondering why you chose Broadcom as your biggest holding. Questions like that, or questions you might have about your specific portfolio. Any questions you have like that, feel free to leave it down in the comment section. I would love to answer any questions that you guys have. And then last but not least, when we're done with that, I want to go over an article that I just couldn't leave out. This has nothing to do with bonds, but I just want to cover an extra piece of news. Nikola's entire quarterly revenue of $36,000 was from solar installation for the executive chairman, the CEO. So their entire revenue was one customer, and it's the guy who's running the business. I remember when I was hating on Nikola when this company was first coming out, and people were giving me all types of hate comments, telling me I was stupid. The stock's going up when it first merged, and now it's lower than what it started at, and I'm sure it's going to go significantly lower than that. I definitely see this a 20, 15, $10 stock, maybe even in the single digits if they don't seriously start stepping things up. But anyways, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I track my annual dividend income, my monthly dividend income, and my portfolio value on an annual and monthly basis. I also track my YouTube income as well, which is over there if you want to pause that. And I do not hide anything from my investors, my fellow people that follow me in my portfolio. I show everything. I show everything that I buy, everything that I sell, all the positions that I hold. You can pause at any moment and see all the positions that I hold right here. This is an order from the biggest to smallest positions. I currently have 30 different stocks in my portfolio. I've actually considered changing a few things around. I just sold Apple for about a 70% gain. And if you want to support me and you're new to the channel, or maybe you're watching and you want to get a sense for M1 Finance, go ahead and use this link right here in the description. You can get $10 just for signing up. That's all you got to do is download the app, deposit $100, and you get $10 free. There's no fees, there's no catch. That's all you got to do, get $10. And speaking of which, even if you're not interested in M1 Finance, go ahead and sign up for some of the other stuff that's in the description. There's things like credit card referrals, information about me, lots of other stuff you need to check out. So go look at the description, and let's go ahead and get started with bonds. Let's go ahead and see how bonds are reacting in this market. So we're going to click the research tab here on M1 Finance. We're going to go to bonds. We're going to go to domestic. We're going to go to government. And then first, what we're going to do is we're going to start looking at long-term treasuries specifically. We're going to see how they performed in this recession. So there's three that I want to focus on, the three that I like. VGLT, EDV, and TLT are my three favorite. So let's look at all three of these real quick and just see how their prices have moved in this recession. You can see their 5-year performance. Bonds are up 40+%. 40%, not counting dividends. They are basically at an all-time high, just a couple dollars away. Let's look at EDV. Let's look at the next one. EDV, you see its 5-year performance up 53%. 53%, and you can see it all-time high, just a couple dollars away. What about VGLT, the last one, another Vanguard long-term treasury bond? 37% in the last 5 years, and you can see that's once again a dollar or two away from an all-time high. And how does this compare to the S&P 500? Well, the S&P 500 is 43%, so nearly an identical performance in the last 5 years, and it is basically about $6 somewhere around there from an all-time high. It is dollars away. Literally, we're talking about 1 to 2% away from being back to its all-time high. As crazy as that sounds, considering that we had a 30+% drop in like 30 days and we are now back at all-time highs like 4 or 5 months later, is incredible, guys. When I started this YouTube channel, it was on April 3rd, I believe, so it would have been right here when the S&P was $248. So the S&P has went up like $75 in that time, actually more than $75. And when I was buying, the dividend yield was like 2.4% or something like that, and now it's at 1.7. So a dramatic move up, and you can see that's part of the reason why my portfolio, the money weighted return is 25%, and then the time weighted return is 16%. An incredible move up in the stock market. I never would have predicted that the stock market would have recovered this fast, and frankly, I don't think a lot of other people would have either. And that's why you see a lot of people losing a lot of money along this ride, trying to short the market, trying to time it, trying to sell right here and then buy back in at the hypothetical second downturn, and then you can see how that's turned out. So now we're going to go to the research tab here, and we're going to look at corporate bonds real quick. We're going to hit bonds, we're going to hit domestic, and we're going to hit corporate now. And I mostly want to focus on investment grade because this is what you want to focus on. You see high yield and you see investment grade. With two different types of corporate bonds, you have junk bonds and you have investment grade. To give you some examples of investment grade, those are very high quality companies like a Johnson & Johnson, like a Procter & Gamble, very safe old companies. And junk bonds are produced by companies like Ford stock and a lot of other struggling businesses and Carnival Cruise Lines and stuff like that. Those are the bonds that you don't want to focus on. While they may pay a higher yield, they're a lot riskier, and the actual price of the bond itself does not perform nearly as well. So I'm just going to click some of the top holdings. You can see its 5-year performance is not doing nearly as good. That said, on a percentage basis, it's not nearly as good as long-term treasuries, but it is at all-time highs. This thing looks like the NASDAQ. It's recovered right back. You can see its peak was at 134. Today we're sitting at 138. Right back to all-time highs. Let's go back. Let's look at some others. VCIT, a Vanguard, for those of you guys that are Vanguard fans, you can see up 11.5%. All-time highs. This year it peaked at right about $95. Today it's at 97. At all-time high, just like all these, and we can keep going. If you just keep clicking through all these, it is all-time highs up 10, 20% through all these, and you see the pattern. Even though long-term treasuries have performed a lot better, they're basically all-time highs as well, and I think that this is going to continue this ride. So my question to you is, you see the stock market at all-time highs, and a lot of you are wanting to do what I'm doing. A lot of you are thinking, oh gosh, maybe I should start moving money over to bonds. Maybe I should start getting a bit more conservative. Well, let's go ahead and look at some economic data and see how it might affect our decision. First of all, let's look at weekly jobless claims this week. U.S. weekly jobless claims total 1.186 million, so about 1.2 million, lowest level of the coronavirus pandemic. So if you see here, here's the numbers. I remember when this first came out and I was covering this on my channel, we had 3 million, we had almost 7 million, and then we had about the same number the following week. And it's been a gradual decrease since. We had a little bitty uptrend here, and now we're at the lowest level since then at 1.2 million jobless claims. Now, not that this is, quote, a celebration, but as crazy as this sounds, that is an awesome number. It sounds crazy to say because even that number of 1.2 million is highest ever in history before 2020. Before 2020, the number barely broke a million ever, and that was during the Great Recession when things... Actually, I don't even think it broke a million. I think during the Great Recession it was like 900 and something thousand. So even this number at 1.2 million is still higher than the previous all-time record before 2020. So not that it's a celebration, but it kind of is. So you can see that jobless claims are starting to look a little bit better, and a lot of jobs are coming back on top of that. So believe it or not, jobs are actually growing. Now that you consider that jobless claims are so low, the amount of jobs that are coming back was more than 1.2 million last week. So we actually improved with jobs. Now let's go ahead and look at one more piece of economic data. Let's look at second quarter GDP and how it plunged by the worst ever 32.9% amid virus-induced shutdown. The U.S. economy suffered its worst period ever in the second quarter, with GDP falling a historic 32.9%. Economists surveyed by Dow Jones were looking for a decline of 34.7%. Neither the Great Depression, nor the Great Recession, nor any slump over the past 2 centuries have caused such a sharp drain in the economy. And let's look at this chart here, and let's just look at how breathtakingly dangerous this looks. You can see, especially back in the early days, you see once we hit the 60s, the 70s, it starts to kind of wither out a little bit. It starts to get a bit more predictable, and especially once we get into the 90s and the 2000s, things turn for a better look. You see it's just steady growth year over year with a little hiccup here and there, but it's basically just year over year, steady everyday growth. And you can see back before the country was as evolved as it is today, things were crazy. You had a 40% quarter in GDP. You had downturns in GDP where it was down 15%, 20%, 25%. But never ever have we seen one in the 30s like quarter two of 2020, a 32.9% downturn. And that even compares with the Great Recession. That's the one thing I wanted to point out here. The Great Recession, you see this number, one of the worst economic downturns this country has ever seen. The financial system was on the brink of collapse. People were losing their jobs. The real estate market was absolutely in the toilet. So many horrible things happened with the Great Recession, and this literally does not even stand close to where we are today. You see, what was the downturn? What was that? Probably about 3-4%. So it is literally 10 times higher than that today. So just keep that in mind. But now going back to where we're looking with bonds. So how is it performing in this market, and should you be buying bonds right now? You got to be thinking about something if you're me. So when I'm buying these stocks, let's go ahead and look at a stock that's just average, performing decent in this recession. Let's go ahead and look at Coca-Cola. The question I have to ask for you is, if you're investing in long-term dividend stocks, if you're investing in safe, stable companies, the two things I have to point out is that with a treasury bond, there's no growth. There's no growth with a treasury bond. You are just buying based off the current yield. And now we'll get onto yield in a second, but you can see how the dividend never goes up. If anything, it's going to be going down since the treasury yield is now lower. But when we look at Coca-Cola, every single year, like clockwork, without fail, it is going to be raising dividends. You can see it goes from 33 cents to 35 cents, 37, 39, 40, 41, and next year will be 42 as well. You're getting a 3.5% dividend yield, which is much higher than that of a current treasury bond. And not to mention, this is something that can grow revenues. This is something that can grow profits. This is something that can change prices, change its business model, make itself extremely more profitable if that's what they want to do. With a long-term treasury bond, that's not something you can do. And let's think about more of upside potential here. Whether we're talking about stocks, whether we're talking about bonds, would you want to buy something that's at an all-time high or that's at a discount? So one of the reasons why I sold Apple, you can see, look at its 5-year performance. I don't need to tell you anything about stocks or anything about this company to tell you there's more than likely going to be a downturn soon. It is $440 a share, and considering that 5 years ago this was under a $100 stock at one point, you can see that this is a massive run-up, and who knows how much longer this will last. Honestly, I sold Apple. I'm even starting to have a little bit of doubts about Microsoft. Even its performance is quite insane over the last 5 years. A $212 stock now, considering that literally in downturn in 2018, this was under $100. 5 years ago, this was a 40-something dollar stock. So you can see that this is a massive run-up, and a lot of these stocks are getting really overpriced, and you see the PE ratio is a lot higher for most stocks. But when you look at a stock with a 22 PE ratio like Coca-Cola, paying you a 3.5% dividend yield just to own it, I think that a safe, stable dividend stock will beat out long-term treasuries. And let's go ahead and talk about yield for a second. Let's talk about the performance of these long-term treasuries and their potential upside. So the long-term treasury yield is insanely low. So low that you can't even really have any upside. So I just went ahead and Google and I just searched 30-year Treasury yield, and I'm on treasury.gov. So this is the United States website. This is the governmental website. You can see that 1 month is paying 0.09, and then you go up and you go up and you go up and you get all the way to a 30-year Treasury bond. So remember how we talked about Coca-Cola and how it's going to be paying out 3.5% dividend? Let's go ahead and look at long-term treasuries. So the treasury that's being bought now, this year, at this current market, is being bought at a 1.2% rate. 1.2. So barely a 1% yield. Even the S&P, even if you're buying in the S&P 500, even it has about a 1.7, 1.8% yield. So basically off of dividends, and once again with the S&P 500, you're talking about a growing dividend. With the Treasury yield, you're talking about potentially a shrinking dividend. So when you're talking about a 1.2 versus a Coca-Cola, for example, a 3.5, 3.6, there's not much potential there. And to talk about these Treasury yields, they're inevitably going to go higher, the Treasury yields will. And what has to happen to Treasury bonds on their price to make the yields go higher? The bond price has to go down. When you have VGLT at these prices and it's at $100+ for its ETF share, and it should be trading in the 90s and the 80s, maybe even the 70s once it downturns, I don't think that there's any upside potential. I mean, you're talking about if you were to buy bonds now and we were to have a horrible recession, and I'm talking horrible. Let's talk about like the S&P You know how today it's sitting at $332 a share. Let's say it goes back to the March lows. Let's say it even goes lower than that. Let's say that this thing crashes to $200 a share. Let's say it goes horribly. I don't think that's going to happen, but let's see. VGLT, you're not talking about it going up to 150 a share. There's not enough upside potential for this to go up to 150 a share. It might go up to 110, 115, maybe. Even that's probably pushing it. 120. This can't go up much higher. So what I'm saying is your downside potential is way outweighing your upside potential, and your dividend is probably going to shrink. And not to mention the price of these bonds are more than likely to go down over the next year or two. I would probably start buying bonds now since we're at all-time highs in a normal environment. But now since we're both at all-time highs, I'm going with stocks because stocks are always going to outperform bonds in the long run, and I'm definitely going to be doing that with my portfolio. If anything changes with these long-term treasuries, and you know me with corporate bonds, I'm not a big fan of corporate bonds because they do not perform as well as S&P and they do not offer any kind of better dividend yields. But overall, guys, that's what I'm doing with my portfolio. And just a quick update on Nikola Corporation. I just wanted to mention this. I won't take too long on this. But Nikola's entire quarterly revenue of $36,000 was from the solar installation for the executive chairman. So basically what that means, in revenue, they did a whopping $36,000 in 3 months. Now I want to remind you guys of something. At one point, this was trading higher than the company of Ford. You heard me right. Ford stock. Actually, is it still trading higher than Ford? So this is a $12 billion company and Ford is 27. Okay. At one point, Nikola is higher than Ford, not to mention Ford has recovered a lot. But Nikola has never produced a vehicle. They have not produced one vehicle onto market. They made a lot of promises, they made a lot of blueprints, but they do not have one vehicle. They have not even been public for 3 months. Why would you want to own this company? And I remember telling a lot of people in comment sections of other videos about talking to people about me, and they're like, oh my gosh, this company's going to go to the moon. They're going to do this. They're going to do that. Why would you want to buy this company when it has nothing but downside potential and $36,000 worth of revenue? Ooh, 36,000. And the one customer they had was their CEO. Sounds like they're really doing great. Go invest in a normal company. Go invest in stocks that are reliable, profitable, and have excellent dividend payouts. And that wraps it up for this video, guys. Like I said, if you're new to the channel, if you want to support me, go ahead and use this referral link. It is in the description of all of my videos. You get $10 just for signing up when you download M1 Finance and you deposit $100 to the platform. They have mobile platforms. They have internet platforms on your laptop. There's different types of ways that you can use M1 Finance, but overall, it is a great brokerage with no fees, and I love the platform, and I think it's going to thrive in the long run with the amount of people that refer to me from it, and a lot of other YouTubers as well. But overall, guys, my portfolio is doing very nice. If you have any questions for me about bonds and how they work, any opinions you might have about whether maybe I was wrong, maybe bonds have more upside potential, maybe you think the S&P is completely overvalued, let me know down in the comment section. I'd love to answer any questions you guys have. Thank you guys so much for watching, and I'll see you guys next time.